Let's talk about chapter one, just kind of a big overview of what financial management is. And I should just kind of let everybody know that the book we're using for class, it's an older book, and I contacted the publisher, and there are no extra materials for it available anymore, which is just fine, not a big deal. I've taught this class a number of times using different books from different publishers. So what I'll be doing every week is kind of putting together PowerPoints that are coming from other books, but will speak to the material that we need to cover every week of the class. So don't be alarmed if you see references in these PowerPoints to books that we're not using. It's just because I had to cobble something together from other versions, other publishers, to get material to use for the class, which is not a problem at all. But just want to let you guys know that's kind of why you'll see a little bit different version of PowerPoint maybe every week, kind of based on what I find and what I put together. So let's talk about an overview then of financial management and what that means. Lots of topics to talk about. Really, I think the big takeaway that I want everybody to have in this class is the fact that the role of finance and the role of the finance manager is to make the firm more valuable. Okay, so and it says here the objectives of the firm is to maximize wealth. So we need to kind of talk about what are the steps, what are the decisions that somebody in finance at a corporation, what kind of options do they have, and what kind of decisions should they make to make the company worth more. So corporate finance, though, is important to all managers. Corporate finance provides skills for managers need to identify and select corporate strategies for basically individual products that add value to the firm. So obviously a company has a lot of managers, senior level managers, mid-level, and so on. But a well-run company is going to allow management at all levels to identify projects that ultimately add value to the firm. So and that project could be almost anything. The project could be going through the decision to replace new machinery, or maybe new technology has come about that can make us more efficient, maybe reduce labor cost or reduce cost of raw materials used in our product. Anything like that could be a decision, but a well-run company is going to make sure that managers are trained at all levels, not just in finance, to try to make those good decisions to do the right things to add value to the firm. So forecasting the funding requirements for the company and devising strategies for acquiring those funds. So that's kind of the second part of it too. As a company grows, or as a company decides to launch new initiatives, maybe it's doing extra research and development, launching a new product line, expanding our production capacity, anything like that. Those are all things that finance should be thinking about, okay, in terms of course, overall corporate strategy, but then once we identify those opportunities, the role of finance is to discover how do we pay for those. Do we find bank loans? Do we sell more stock? Do we issue bonds, or some combination thereof to raise the funds needed for expansion and growth and to meet our strategic decision making that we want to do down the road? Now, our class will focus primarily on corporations. That's going to be the big takeaway. But I do want to come back and just mention other business forms also. A sole proprietorship, typically when a business starts, typically it's a person starting out as a sole proprietor, and then as they begin to grow, maybe they find a partner, form a partnership, then ultimately as the company continues to grow, becomes more successful, typically at some point you end up incorporating. And the reason you incorporate is because you have more access to funding. It allows the company to grow a little bit more by doing the corporate form. So just some FYI, and this is stuff that maybe you've seen in other classes or in the process of earning a bachelor's degree, maybe you've come across some of this stuff, but I never want to assume that everybody has the same knowledge base. And so I think it's always good to kind of cover some of these topics and make sure we understand what business forms are. So for starting up a partnership, advantages, very easy to form. Very few regulations to start a proprietorship. And really this goes for a proprietorship or partnership together. Either way, kind of the same thing. And there's no corporate income tax on that business form. So a sole proprietor or a partnership, very easy to form. It's just a matter of obtaining a bank account, and that's really about it. And the business itself never pays tax. The owners pay the tax instead. So all the income of the business flows to the owners, who then pay the tax on their personal tax return. So disadvantages: limited life. If the owner chooses to end the business or sell it, then the business ends. And unlimited liability is probably one of the bigger ones. Basically, think if your sole proprietorship or your partnership goes out and takes out a bank loan, the concern then is if the business fails, it's very possible that your personal assets will now be subject to being sold to repay the bank loan. So quite often for a sole proprietor or partner to obtain a bank loan, what they'll have to do is personally guarantee the debt with the bank before the bank will grant the loan. That's a very common thing. So you're putting your personal assets at risk in order to get the loan for your business. And also the difficulty to raise capital to support growth. And we'll talk about that when we get into the corporate form. Some advantages of the corporate form are that there is more access to raise capital. So for partnerships and proprietorships, you set pretty much the same situation: advantages, disadvantages. They're really the same. So corporations, though, and that's really where the heart of our class is with the corporate form. It's a separate legal entity. Okay, it's a separately owned. The government kind of views a corporation as a separate person. A corporation can enter into legal contracts. A corporation is a taxable entity. So what you do is you file papers to incorporate with whatever state you want to incorporate in. That typically also means you have to file bylaws with that state to let that state know, here's our corporation, here's how it will be governed, things like that. You obtain a charter from the state that allows you to operate. So advantages: unlimited life. So think about stockholders of a publicly owned corporation. Think of any big company that's publicly owned. I like to use Costco as an example. So imagine if you own Costco stock. Costco has unlimited life because it's a corporate form. If I own shares of Costco, essentially what that means is that I can, if I were to pass away, clearly Costco keeps running, right? We all know that the business doesn't end. My heirs inherit the stock. Then easy transferability of ownership. If I want to sell my stock, I can do it really easily. I can log on to an online brokerage account and sell it within seconds. Between logging in to selling it, I can probably do that in 30 seconds. Limited liability. Basically, if I own Costco stock, the limit of my liability for anything is the value of the stock. If Costco were to go bankrupt, my stock is worth essentially nothing, and that's what I'm out. I'm out my investment, but nothing else, because Costco's creditors would not be able to come after me for my personal assets to seek repayment on loans. So it kind of ends right there. And probably one of the biggest reasons companies go public is the ease of raising capital, because you can now sell stock of your company. And so now you have the ability to sell stock. You can issue bonds now. Banks typically would prefer to lend to a corporation over a smaller partnership or proprietorship. So those are the big advantages. Now, disadvantage, though, is there's two big disadvantages. The first one's double taxation. And I mentioned earlier that corporations are a separate taxable entity. The IRS views them as a taxable entity. So corporations pay tax on their earnings, and then corporations that choose to pay dividends to their shareholders, and their shareholders have to report dividends as income. So the corporation pays tax on earnings. Earnings left over after tax then can be dividended away to shareholders, who then receive that income, but it's taxable income. That's the double taxation. And there's also the cost of setup and report filing. So the downside of corporate form is it's a very expensive form. You're subject to a lot more regulations. You have to file with the Securities and Exchange Commission, the SEC. That requires having a army of accountants and lawyers that work for you, and also make sure that you have to have maybe an audit firm that does your audit every year, and outside legal counsel also. So it just requires more infrastructure within the company, and it requires that you have more auditors and lawyers on call or retainer to do your filings and reporting for you. So it's just in a more expensive form. A corporation I worked at, just the audit fee that we wrote to our public audit firm every year was a little over $1 million. So that was just the audit fee. That doesn't include the cost of more internal people on hand, and then lawyer fees and filing fees and all that kind of stuff. So it is a very expensive form. So when you go public, it says here, become a public corporation and growing afterwards. If you hear that term IPO, that stands for Initial Public Offering. And that's when a company first goes public. And so when they first go public, they sell stock of the company, and the cash raised goes right back to the company. Okay, and so basically that allows founders, and it says here, to harvest some of their wealth. And we can all think of really big companies that have gone public. Facebook is a really relevant one to kind of mention. We all know Mark Zuckerberg started Facebook, and it's been probably 5 or 6 years now when they went public, but it allowed him to harvest some of that wealth because he then gets founder shares of the company, and now he owns a bunch of these founder shares of stock that he can easily sell in the market if he wanted to. And then also, once you go public the first time and you sell stock, you can continue to sell more stock down the road if you want to. You can have various classes of stock that you issue, and of course you can keep issuing bonds and things like that. So just the corporate form has just more avenues to pursue when it comes to raising capital, as opposed to smaller firms, sole proprietors and partnerships that really kind of have to rely on loans through banks or the owners raising funds and putting funds in on their own. So corporations have the definite advantage of being able to raise more funds. So a big issue we talk about in finance is what we call the agency problem and corporate governance. And the question I like to ask everybody in a finance class, to all of my students, is, have you ever made a decision that benefited your own interests? And the answer better be yes, because we've all done that. And we have to do that. You have to look out for yourself. You have to make decisions that are, out for me, for my best interests. And at the same time, also think about jobs you've had and think about, how do you keep your job, right? Well, you keep your job by typically doing what your manager or supervisor asks you to do, by meeting and exceeding expectations, by doing a good job, listening, doing what you're told, meeting deadlines, and so we all want to do that, right? And so the issue here with corporate governance, or the agency problem, is that managers of corporations may act in their own interests, which is possibly counter to the interests of the owners or the stockholders of the company. So the way the corporate form works is, the stockholders are the owners. They own the company. And the stockholders elect a board of directors. And for every share of stock you have, that allows you a vote for the board of directors. So you vote for the board. And then the board is in charge of hiring, or basically holding accountable, the very top management of the company. So think president and the various chief officers, like a CFO, COO, and so on. And so making sure that they are doing their jobs and making decisions in the best interest of the shareholders of the company. Okay, so that's really what that means. So corporate governance is rules and bylaws that a company has on hand that monitors the behavior of employees, directors, managers, shareholders, creditors, customers, competitors, community. Basically, any stakeholder of a corporation should be governed to some degree by the corporate bylaws and corporate governance. And you could do a whole class based on corporate governance. But that's the agency problem, is how do you make sure that managers are looking out for the best interest of the shareholders and not necessarily themselves. So management's objectives, and as I mentioned, this class is about making sure that management, especially management involved in finance, make decisions to make the company worth more money. And so the primary objective of management's decisions should be shareholder wealth maximization, which means making decisions that elevate and maximize the stock price. Okay. Of course, doing that within a very ethically bound system, making sure you're not making unethical decisions to do that. And it says here, do firms have a responsibility to society at large? And the answer is yes. Shareholders clearly are also members of society. And of course, corporations employ employees who are members of society and so on. So you have to find that fine line between maximizing corporate wealth, but yet making decisions that are ethical and still investing in your community, investing in society. That means donations, things like that too. And hopefully you're aware of companies that have made significant donations to charitable causes or things like that too. And there's been many examples I can think of, and maybe I'll share a few in a few moments here. So one thing I want you to think about, it says here, is maximizing stock price good for society, employees, and customers? Generally, of course, the answer should be yeah. I mean, I've been telling you that should be the goal of people, management and finance, is to make the company worth more. It says employment growth is higher in firms that try to maximize stock price. Okay, on average, employment goes up when firms make managers into owners, in firms that were owned by the government but have been sold to private investors. So, but think about any job you currently have or have had in the past, and I want you to think about what kind of actions from the company make you feel more invested in the company, make you feel more proud of working for the company, or make you feel like the work I'm doing or the work this company does that I'm working for makes a difference in society, people's lives, makes lives better, things like that. And think about what makes you a better, more motivated employee. And typically, if you work at a company where you can see how your role fits into the big picture of what the company is trying to accomplish, you believe in the company's mission, you're invested in that mission, you think it's that mission of the company is very worthwhile to make the lives of people better. And an insurance company that I worked at, its motto was to make lives better. And they kind of took that from, and it was a life insurance company, make lives better. You'd think that might be odd at a life insurance company because you're insuring people's lives and you only make payments to people if somebody were to pass away. But the purpose of saying we're going to make lives better was to say we want to protect people financially, so that if the main breadwinner of a family were to pass away, that life insurance was purchased, and enough of it was purchased so that the beneficiary of that person who passed away will receive that and be comfortable in life and have enough money now to meet expenses and send kids to college and whatever it's going to be, that we made that life better because this person invested in us by buying a life insurance policy. So we looked at things from a customer perspective, but we also looked at things from the employee perspective, and this company would match employee giving dollar for dollar. So employees were allowed to give to almost any any charity, and the company would match that dollar for dollar. So what they said was, we want to invest our dollars where our employees are telling us it's important to them. And so if employees are saying let's put money here, and the employees put it here, wherever that here is, they would match a dollar for dollar with no restriction. If an employee gave $10,000, they'd match $10,000 with absolutely no restriction. So that makes you feel like, okay, my company cares about me. They care about the things that matter to me because they're going to match what I do. And they also gave, you could take so much time off per year during the day, or to do volunteering and things like that. So that's a company saying, yeah, we're giving money away and we're letting our employees work, for free essentially by volunteering, but that makes our employees happier. They're more likely to stay with us. We don't have turnover as much as we might have had. If our customers believe that's a big deal and they choose to do business with us because they see that we're giving back to the community or society, then maybe we even get more customers. So that's kind of how you have to look at it from a corporate perspective. Yeah, we're giving money away or giving our employees time away, but that should be really thought of as an investment in the future. It says here, consumer welfare is higher in capitalist free market economies than it is in economies of social socialist economies, and I think history proves that repeatedly. And obviously, we live in a capitalist free market economy where we have a lot of freedoms, a lot of freedom of choice. And think about what that means in terms of our dollars. And I teach junior achievement to fifth graders, and we talk about free market capitalism to fifth graders. And I always ask them the question, you receive some money from, maybe they did a babysitting job, or they received some money for Christmas or a birthday, and they want to spend it on something. And I always ask them how they decide where to spend their money and what to buy it on. And quite often it's, I'll go to a couple different stores, I'll look around for the best price, or I'm looking on the internet for the best price for something that I want to buy. And they're competing. So I tell them, how do you choose what business to spend your money at? And they go, convenience, price, quality. Some brands, they'll talk about some brands have higher quality than others. So, but think about, in capitalism, businesses have to convince us to spend our dollar with them, and that's the beauty of capitalism, is that competition makes sure that the products and services that we're paying for are better, because businesses are competing. And so we only give our dollars to businesses that we perceive as value and quality or convenience or whatever that is. And so that's, obviously, that's what the U.S. economy is based on. So on the flip side, though, companies also have to be well run. They have to be perceived as being ethical and caring and giving also. So some companies are work very closely or work very hard at their reputation. Their ads are very focused on, here's who we are, here's the good things we do, here's the products and services we've developed that make people better, make lives better, make society better. You'll see a lot of ads like that too. Okay, so it says here then, what three aspects of cash flows affect an investment's value? So going back more to cash, because cash is king in finance. And a lot of financial assets, most financial assets, are valued at the present value of all future cash flows. And so the big things is basically, how much cash do I expect to receive from an investment? Bigger is better. What's the timing of the cash flow? Sooner is better. And what's the risk of the cash flows? Less risk is better, right? Some investments we know have risk, some don't, or some have various degrees of risk. We're going to use the term free cash flow a lot throughout the class. Free cash flow are simply free cash flows that are available or free for distribution to all investors, stockholders, and creditors. So the definition of free cash flow is right here. Free cash flow is sales revenues minus operating costs minus operating taxes minus required investments in operating capital. So think about a business, maybe one you work at now, worked at in the past, or even think about your home. And my question is, do things wear out? And the answer should be, well, of course things wear out, right? And that's what that last part means. Required investments in operating capital is, for a business, for you and I, things wear out. Appliances need replacing, cars only last so long. A business that's manufacturing goods, machinery needs to get replaced every so often. Delivery vehicles need to get replaced every so often. So just think about that. That's what they mean. So minus required investments in operating capital means every year you have to invest in yourself to maintain your current capacity. Okay. Of course, you can invest extra to try to grow your capacity, but there's a certain minimum investment in infrastructure you have to make just to maintain current capacity, just to replace things that have worn out and so on. So that's what free cash flow is. Sales minus your operating costs, minus taxes, minus that required investment to maintain current capacity. So that's what free cash flow is. Just kind of keep that in mind. And the WACC, or weighted average cost of capital, is the average rate of return required by companies' investors. And the WACC of a company is kind of fluid. It'll change. I worked at a company where we calculated what our WACC was on a quarterly basis. I was at a company we just did it once per year, but it changes. It ebbs and flows a little bit, which is good. I mean, and it kind of makes sense because in the economy, interest rates change all the time, and interest rates would drive a portion of your WACC calculation and what that WACC is. So that's what they mean by that. So they talk about what your capital structure is, and your capital structure is, what is the mix of debt versus equity financing. So debt, of course, is borrowed money. Equity financing is stock. What's the level of interest rates? How much risk does the firm have? Clearly, some businesses, some industries have more risk than others. If you were to invest in a public utility like a natural gas or electricity company, there's not a ton of risk with those because they're regulated so heavily. They've got customers who need to buy their product, so there's not a lot of risk. But if you were to invest in an airline, and if the economy is doing well, the airline will do great. But if the economy starts to slow down or become recessionary, what do people do? They cut back discretionary spending. And so the airline revenues may fall. And so there's more risk in a company like that. So some companies have more risk than others. And of course, part of it too is just as an investor, 10 of us in a room might have 10 different levels of risk tolerance. Some of us might tend to take more risk. Some of us may say, well, I prefer to play it safer with my money. And there's no right or wrong to it. But businesses are no different. Some businesses will take more risk. Some will kind of just really play it safe and not take any risk at all. So it's just a matter of what that risk tolerance is too. And this talks about intrinsic value. And for a company, intrinsic value is the sum of all future free cash flows converted down to an amount today. Okay, and obviously we have no idea what all future free cash flows can be, right? There's no way we can know that for a company. You can certainly estimate that though, and we can always know what free cash flow is today. We can know what free cash flow has historically been for a company, and we can visit with the company or look at their reports, financials, anything about them in the press, interview leaders of the company, and maybe get a feel for what free cash flow might be for next year, the year after, and make predictions about what future free cash flow will be. But I can do that and bring that down to a number today and use that to value a company. That's basically what they call the intrinsic value of a company, is what's the present value of all future free cash flows. Now, this is kind of a big, ugly slide. There's a lot going on here, but I'll kind of walk you through what this means. So the top in the yellow means here's how we compute free cash flow. Sales revenues minus operating cost and tax minus required investment in capital is my free cash flow. I've mentioned that already. And then the previous slide said the value of a company, the intrinsic value of a company, is the sum of all future cash flows brought down to the value of time today. Basically, free cash flow divided by 1 plus the WACC to the power of time. 1 year, 2 years, 3 years, and then the infinity symbol and so on. Okay. So the weighted average cost of capital, though, what is that? And as I mentioned before, lots of things go into what that number is. What is the market rate of interest? What's the attitude about risk on the market? What's the debt versus equity mix of the company? And how risky is the business? And all that boils down to what is the cost of acquiring debt financing? What is the cost of acquiring equity financing? Bring that down to the weighted average cost of capital, basically the cost of going out and acquiring new capital, typically the rate of return investors require from new investments. And also in finance, it's important to understand that we have to match users of capital with providers of capital. And it says savers and borrowers, providers with users. The more efficiently we match those two groups together, the more efficient our economy runs, and the better it is for me and you, for everybody. If businesses can easily acquire the capital they need to grow, expand, finance operations, that's important. If you and I can easily access funds to purchase a home, purchase a car, school loans, credit cards, whatever that would be, obviously within reasonable limits, the more efficient we can have access to those kinds of things, then the more affordable ultimately becomes buying a home, buying a car, affording education, whatever that may be. And so efficient financial markets are where borrowers and savers come together efficiently, which can be on the internet, it can be in a physical location like a bank, but the quicker and easier these two groups find each other, the more efficient our markets are and the more efficient our economy is. So obviously, some households are net savers, some are net borrowers. Non-financial corporations can be either net users or borrowers. Governments typically are net borrowers, unfortunately. I wish they weren't, but they are. And financial corporations, it says slightly net borrowers, but almost break even. So we're thinking here insurance companies, pension funds, um, um, mutual funds, things like that. Certain businesses have a lot of capital that they're looking to invest and grow for their customers and employees. And there's really three ways that capital can be allocated. The first one's direct transfer. The borrower and the saver find each other and negotiate a deal. Um, Having been in insurance, insurance companies have a lot of cash, a lot of extra cash, and quite often other businesses will just approach us directly and say, we have an idea for an investment. Would you be interested? We've done some big mortgages for some businesses that we've helped to finance expansion of factories by writing a mortgage on it for a business to do that. So it's just the two sides getting together, making a deal, and that can be good because there's no middleman that gets a cut of the action. Obviously, if anybody's bought a home or whatever, there's a realtor involved, and that realtor is going to get a commission, right? They're going to get a certain amount of the sale. But if two sides meet together and one buyer and one saver one saver and one provider of capital without a middleman, that transaction happened more efficiently without a commission. Okay, so that's one. Those don't happen a lot though, but they definitely happen. Investment banks are very, very common, especially when it comes to a business issuing stock or bonds. What a business will do is work with an investment bank who kind of underwrites the security. They will take on a lot of the risk. They'll do the regulatory filings. They will figure out how much demand there might be for the particular stock or bond, and then they will help sell that issue. And they'll find savers willing to invest in that stock or bond. The dollars come to the investment bank. They take their little commission, and the rest of it goes back to the business that issued the securities. And the bottom one is just any other financial intermediary. Just think of a bank. So whatever your bank account is at, if it's a bank or credit union or whatever that is, every time you put money in savings, you just gave that bank the ability to lend money to somebody else. Okay, and banks can lend up to 90% of their reserves. So if you put $100 in the bank, in your bank account, that bank can now lend 90 of that to somebody else as a loan. Okay, and so that's that in between. The bank is that financial intermediary. So we can go to a bank to do investing, to do saving. You can put savings accounts, CDs. A lot of banks will help you out with mutual funds and things like that. We can also go to the bank to get a car loan, a home loan, a student loan, credit card, you name it, right? So that bank can be both sides, borrowing and saving. They're that intermediary that you can go to, and they take care of both sides. And of course, nowadays, those things can happen all online. You can physically go to a bank and do those things however you want to do it. But those are the things that we can do nowadays. And so this is kind of the same description of what I just got done telling you guys from the previous screen. So that's pretty much the same thing. Now, cost of money. There's a cost of raising capital. There's a cost of borrowing. Clearly, we all know that when you borrow, you pay interest. So if we go to the bank and you borrow money for something, if it's a home or a car, you're paying the principal back to the bank plus interest, right? So it says here, what do we call the price or cost of equity capital? Basically the cost of equity. And the cost of equity is kind of made up of both the required return, which is also the dividend yield, plus the capital gain. And we'll talk more about that in future weeks of our class. So the cost of money, basically what is the interest rate or the cost of acquiring capital, is determined by what are the other opportunities out there to raise capital, what are you competing against. The time preference of consumption, do you want it now, do you want it 5 years from now, 10 years from now. The amount of risk that this business is undertaking, and then just finally, what is the amount of inflation and expected inflation in the economy also. Now, I mentioned earlier that interest rates change all the time. They go up and down, they ebb and they flow, and interest rates are really driven by a lot of different factors. the Fed, the Federal Reserve. Congress created the Federal Reserve a very long time ago to kind of oversee our banking system and our money supply in our economy. And so the country is divided into different regions of the Fed. I know that where I live in South Dakota, our Fed Reserve branch is in Minneapolis, Minnesota. I'm not sure if Nebraska is in that same region or not. I'm going to guess so, but I could be wrong about that. So basically, there's different districts of the Fed, and that kind of regulates certain banks within their district. And they can set policies when it comes to banks borrowing money from each other or borrowing reserves from each other. You can borrow from the Fed, a bank can, and so on, and they charge interest rates, and that determines the amount of money in the economy and determines interest rates and things like that. And of course, just the federal government overall, state governments, as they're operating in either deficits or surpluses, that affects interest rates. Is the overall economy in a recession or a boom? And then what's going on internationally? Do we have trade deficits or surpluses? We have a very interconnected global economy now. And so, if China is having a poor economy, that may negatively impact us and vice versa. So it's kind of all interconnected to some degree. There's all kinds of financial securities. Our class will spend some time on some of these. We'll talk about some more than others. When it comes to debt, you can see here, now money market means short term, capital means long term. So short term, T-bills, CDs, T stands for Treasury, Euro dollars, Fed funds. Those are all short term debt that you can undertake. More longer term debt is Treasury bonds, agency bonds, municipal bonds, and corporate bonds. Then equity refers to ownership, common stock and preferred stock. And derivatives are financial instruments that derive their value from something else. Options, futures, forward contracts, interest rate swaps, things like that. So we're not going to spend a ton of time on those. You can spend a whole class just on derivatives. But for a corporate finance class that's within the core of an MBA program, it's kind of just be aware of what derivatives are, and we'll spend more time on them in the future. But we're going to focus most of our efforts on debt and equity. So financial institutions, there's lots of them out there. Commercial banks, that would be like where I live. Great Western Bank is a commercial bank as an example, which Great Western Bank's in Nebraska too. Just a bank you can go to do your kind of normal banking as an individual. You can get your investments, you can do savings, checking, credit card, mutual funds, CDs. You can do various loans, consumer loans primarily. They do, most commercial banks will do commercial lending also. But the investment banks are really working more with corporations and bigger businesses, and they're helping them issue stocks and bonds. That's really what they're mostly doing. Savings and loans, mutual saving banks and credit unions, very similar to commercial banks in what they do. Life insurance companies where I used to work, obviously people pay their premiums. Life insurance companies have a lot of cash coming in. They turn around and invest that and try to grow their portfolio so they can afford to make claim payments. Mutual funds, ETFs, which are exchange traded funds, we'll talk about those in the future. Pension funds and hedge funds are all just different examples of institutions that have a lot of cash, a lot of money, that they turn around and look to invest in there. They supply capital to the economy. There's all kinds of markets also, and obviously if you were to say I'm going to the market, you kind of think of a physical place, like your grocery store would be a market, obviously. You go to the market, you buy things, right? So I go to the grocery store, there are physical assets, things I can look at, see, and touch that you bring home. But a market is any place where you can exchange one asset for another. And you can hear, of course, we can talk about physical assets like the grocery store, or like what we're going to talk about, financial assets. And spot versus futures means spot means now, future means sometime in the future. Money versus capital markets, a money market's short term, and capital market is long term. And then primary versus secondary. Primary means it's the initial, like an IPO is a primary market. Next, the next slide is going to tell us. Actually, let's go to the next slide. We'll talk about that. So primary market is a new issue, an IPO. So the only time a corporation receives money for selling stock is in the primary market. When they first issue the stock, it's purchased by whoever owns it. The corporation then receives that cash. After that, the stock is bought and sold between interested parties on secondary markets like stock exchanges, like the New York Stock Exchange, the NASDAQ, and so on. And if you were to create your own brokerage account and buy and sell stock, you have no idea who you're buying and selling to. You don't know. But that secondary market, though, is important because it allows people to buy and sell to each other quite easily. And then it says here two dimensions of classifying trading procedures. Location means a physical location. Now, when it comes to stocks and bonds, it's almost always done more by computer and telephone. Now, there is physical locations where stocks are traded. New York Stock Exchange, for example, would be one of those. But more and more of these things are happening more online. So just kind of think of a room full of servers somewhere as really being a financial market nowadays, where there's so much automation and the internet. I mean, you can literally buy and sell a stock on your phone if you have a brokerage account set up. You can do it very quickly and easily. So it happens more now online, where you have a broker who is facilitating both sides of the transaction. If you log on to your account and say, I want to buy 10 shares of Costco, and assuming you have the cash in your account to do that, they'll go out and buy the 10 shares for you, and you have no idea who they're buying them from, and it doesn't matter. Flip side, if you said, I want to sell my 10 shares of Costco, they'll sell them to somebody for you. They do it really fast. They sell it for whatever the price is on the market, and they make a little bit of a commission on that. They charge you a fee. They make about it, depending on the stock, they make a couple of cents per trade, per share, plus they'll charge you a fee. $5, $7 are pretty good examples. So if you were selling stock or buying stock, a couple types of orders you could do would be a market order, which basically just says, I want to buy or sell now at the current price, or a limit order is I'm only going to buy or sell if a certain thing happens. So for example, let's just say I bought Costco stock and I can't remember what it trades for. Let's say I'll make up a number and say it trades for 150. Let's say I bought Costco at 150. And let's just say I'm afraid it might go down in price. And so what I could tell the system is, if it hits 130, sell it. I just don't want to own it anymore. Or same thing, I could say if it hits 170, sell it. Whatever I want to do, I can set that number up on those conditions, and I can make them be live as long as I want to. It's kind of up to me. Okay, but that's what a limit order is. It's just you're setting up some rule in the system with your broker to buy or sell if some condition of a price happens. So broker-dealer networks is basically just that network of brokers that are facilitating the buying and selling of stock through exchanges. It just basically just happens. There's different exchanges out there: the NASDAQ, New York Stock Exchange. Those are a couple of the bigger ones right there. And then this talks about what those are too. The New York Stock Exchange is a physical location, obviously in Manhattan, and the NASDAQ is really just a room full of servers. It doesn't have a physical location. When you buy or sell a stock, it doesn't matter at all what market it's trading on. It just makes no difference whatsoever. And there's more than just these two. It doesn't matter. So it's kind of irrelevant what market you trade on. But the New York Stock Exchange is the biggest of the big. Are the ones that typically trade on the New York Stock Exchange. So anyway, that's just a big overview. Read chapter 1 of your book to give you just some kind of a broad background of what this finance thing is, and we'll kind of get into a few more number crunching type of things in future chapters. But I hope that made sense. And as always, if you have questions,